All right, let's turn to precious metals. The gold price holding steady largely today, but still set for its worst week since late November. Of course, we have seen those strong rises, particularly since the outbreak of the conflict in Ukraine. Let's get some analysis on what's going on in that space. We're joined by Davide Bosio from Shaw and Partners. Great to catch up with you again. All right, so what's been moving that gold price more recently, I guess, particularly as we've seen it slide, and as I said, given we've seen some strength there appear certainly since that conflict broke out.
Yeah, thanks for having me, guys. It's very interesting times out there for the gold bulls, and anyone looking at the precious metals markets probably, and rightly so, is scratching their head every so often, just saying, well, it's a very, very difficult market to read at the moment. But we've obviously seen a very, very big run up, and the price did spike through 2050 in the last few weeks on the back of really the Russian invasion and these these war-based or geopolitical concerns that we have out there. So, which is the normal reaction, something you'd expect in the gold market. Especially over the last week, I think we've seen a lot of I guess the fear and the sentiment has shifted. There is a lot more talk around how the world kind of resolve some of these issues, or how Russia and Ukraine move through this, and we've seen some of the commodity prices settle down, and gold has subsequently fallen. Last time I checked, it was around 1930, 1935, thereabouts. So it's had a decent fall of call it over $100 on the back of that. But one thing I'd just remind our investors to look at is that real correlation between a strong gold price, or the gold price, and real interest rates. So we're currently in a very unique market where we've got an environment of rising rates. It's pretty clear that rates are going up. I think everyone's would probably agree on that. But then you look at inflation. So the rapid pace of inflation still far outweighs that rise in interest rates. Therefore, real interest rates are still declining, which is a very positive underlying factor that drives the gold price. So if you're a gold bull, just remind yourself of that every so often before you go to sleep, and it'll help you to get through the next day as we wait to see gold making new highs.
And how's this playing out, particularly with the gold miners themselves in those listed? Once again, largely underperforming, certainly over the past year or so, compared with their global peers. They have since picked up. Are you still seeing some value there?
Oh, definitely. The gold equities themselves, again, frustratingly, have done very little to get themselves off the canvas. But again, you have to it comes down to your time frame. But if you take the longer term view here, there are many positives, and there are a few negatives. So obviously, I'm based in Western Australia, so very, very largely driven by resources, iron ore, gold in particular. The challenges that the local producers have is widespread, and I think this is global, but we've seen a lot of the gold producers themselves coming out now and seem to have lost a bit of their control over their margins, which is a result of very, very good gold price for a producer. So most of them are still making very, very good top line numbers. However, the challenges around lockdowns, around the transportation of human capital, of logistics challenges, of cost inflation, is really weighing on the margin. So gold equities themselves, I think looking forward, many of the analysts, many of the people that are out there valuing these companies are saying that the future is still challenging for the producers because of the cost pressures that they do face. But when you look through some of these gold equities, they still seem, on a relative basis, quite well priced. They are still spitting out a lot of free cash flow. Many of them have very, very low debt, if any. So they've got lazy balance sheets. Their core businesses are very, very strong. And with the current gold price, I'd still argue that this is the environment that's conducive to significant deals. So we've seen a lot of our majors going out there and doing some very, very well priced and well timed acquisitions. And I do believe that any tier one ore bodies, tier one discoveries are going to be extremely valuable for an existing producer looking to replenish their production.
Can you name any names?
Oh, I think it's the household names. It's the Northern Stars, Evolutions, Newcrest. Those guys there are extremely well positioned. If you kind of go down the curve, and some gold fundies really like the plays that have underperformed and probably have had a few warts on them. So if you look at companies like Regis and St Barbara, they've both been very unloved by the market. So potentially their takeover targets themselves. If they continue to underperform compared to their peers, they may be available, call it on a cheaper valuation than some of the better producers. But if you look at the Northern Stars of the world, they've got a fantastic growth profile or production profile across a number of tier 1 jurisdictions. If you go down the curve as well, again, so if we look at some of the mid caps or the large mid to large caps, companies like Ramelius have been very, very aggressive, and they continue to perform well, albeit with some cost pressures, but they have been extremely acquisitive. And I think those companies that are out there leveraging their free cash flow into new acquisitions, hopefully we see them rewarded going forward.
All right, let's look a little more broadly then about what's going on in the resource sector at the moment. And M&A, are you seeing any particular deals ahead that excite you?
Yeah, as I mentioned, with a lot of free cash flow and positive sentiment around a sector, and again, right now, I think if you're a producer in resources, you're a market darling, and all of a sudden, a lot of analysts want to take your call, and a lot of analysts are making the calls to the management teams, which at times is unheard of. So there is a lot of cash out there in the system. So again, if you have a lazy balance sheet, low gearing, there's a lot of investment banks out there with a lot of money at the moment looking to really fund these acquisitions. And we've seen some companies and a couple of call it larger caps that kind of spring to mind, but you've got things like South32, companies like South32 that have really had call it a base metals portfolio that was almost regarded as all the things that BHP never wanted. They kind of package it up and put into South32. Now, all of a sudden, they're absolutely killing it, and they're doing very, very well. And we've seen a capital management policy that they've implemented very, very well, where they've been rewarding shareholders through dividends, but also very, very strong buybacks. And if you look at the chart on South32, for example, it's extremely good use of their capital. Companies like Whitehaven Coal, completely unloved due to the sector, and we can all appreciate the reasons why, and many investors will still fail to touch a company like Whitehaven, but they are generating enormous amounts of free cash flow. So when you see companies like that are generating so much free cash flow, paying dividends, then buying back their own shares, a share buyback, really at the true heart of it, is telling you that the company believes that out of all the opportunities in the marketplace, the best opportunity they see to use their money is to buy their own shares because they present so much value. So it's a very, very strong strategy on behalf of a company when they do start to do that. Now, for a sector like coal, which is so unloved for various reasons, we could see private equity stepping back in, which they have done it in the past. We've seen them enter sectors like energy en masse, where they come in and they say, right, this sector is unloved, the public aren't valuing them correctly, and they are making so much money that we're just going to step in and buy them. So I do feel that as this resources boom matures, we're going to see a lot more opportunities. And again, I for one being skewed to or biased towards gold, being high value at the moment, I'd love to see some of these majors stepping down the curve and starting to make plays for some of the mid-tier miners and even the juniors, for that matter, the junior explorers and companies out there looking to make the next discovery.
All right, not just the producers, but the explorers too. You say that's the space to be in.
Absolutely.
Yeah.
David, great to chat with you. Sorry, go on.
Thanks, Cara.
No, continue with that thought. But about you're saying definitely. Just expand on that then.
Oh, and this is where we have a lot of conversation with people, and it feels like the markets have, they've been very strong for a long time. So a lot of people start to say, well, the market's too high. When does this end? I still feel that we haven't seen the real party yet, and it's a bold statement to make because it has been very good in the capital markets really for the last few years. It's been very, very good, but really to see, the top of the market really presenting itself, we want to see some aggressive takeovers. You want to see some aggressive steps by companies, and that means it's not just what I believe we've seen in the M&A cycle has been quite sensible opportunities that have been taken advantage of at fair valuations, at quite conservative valuations almost. We've seen mergers where companies are coming together saying, well, let's not overpay, but let's bring these companies together. That's still a very controlled environment. And I think once we start to see companies stepping in and saying, right, there's discoveries out there, there's some explorers out there that are doing good things. Let's grab these companies, let's have a crack at those. That's when I think we're going to start to perhaps get closer to the top of what this cycle looks like, but I don't think we're there yet. So fingers crossed, we've got a little bit more of a way to go.
Sorry, just to clarify that point there, as far as timing, when you say it's a longer term view that you have, how long are we talking, do you think?
Okay, well, now you're asking me to stare deep into that crystal ball. I'll go back a step, and I think in January, you could look at the market and really say it feels like it's fully priced. It feels like everyone's a seller, and it feels like there's really no room where to move. And since the start of this calendar year, we have seen a couple of quite severe pullbacks. So we've seen, I think what's fair to say was that early correction, which was quite swift, quite severe, and following that, we've now seen the invasion into Ukraine, which again has created a lot of uncertainty and some fear in global markets. So if we just look at that though as an event, what we've seen is a repricing of equities, and we could say that the markets have been very hot and they needed to come down a bit, which they now have. But also, again, if you get one of those charts, which I'm sure many of our investors have seen time and time again, of looking at global war, global uncertainty, and invasions, things like what we've seen, typically the date of the invasion is almost to the day the low in the markets, and we normally see markets starting to improve on the back of that, rightly or wrongly. It's I guess one of those events that seems to repeat itself time and time again. So I would say if we look at the invasion of Ukraine as almost a bit of a resetting event, I do think that we could see at least another 12 to 24 months of growth ahead of us. And there is a lot of money in the system. And although we're talking about the price of money going up via interest rates, there is still an abundance of capital in the markets, and you can see that we still have these SPACs who are billion-dollar companies looking to do a deal, and we saw that today with Metals Acquisitions Corp, buying the Glencore asset for I think it was $1.2 billion. There are companies out there spending that sort of money on significant assets. So I do feel that we still have a way to go, and until I think we see real challenges at an earnings level, and it could come from cost pressures, but I do feel, especially in Australia, we're still reopening from the COVID trade. In Western Australia, where I'm based, we're only going through the reopening trade now. We're getting an increase of cases every day, and we still are yet to peak, which again, our friends on the East Coast, you guys all have lived through this over the last 3, 6, 12 months. We're just doing it now, but we had to reopen to enable labour essentially to come in, the logistics to get back to normal. So I think those benefits of really getting back to normal are still yet to be seen in our local economy. So I'd like to think we've still got 12 to 24 months here at least where we should see companies still performing very well, which should sustain this current buoyant cycle that we're currently in.